Let's connect with Mark Matthews. He's head of Research Asia with Bank of Julius Baer, who joins us live from Singapore. Later in the day, the US Fed Reserve will end its two-day meeting. The widespread consensus is that they will continue with their tapering program. What is your assessment?
I think they will. The data, obviously, which was soft in the winter, is now getting better again, and they've basically committed to winding down the program. They realize that they can't keep buying bonds in perpetuity. It'll explode their balance sheet. And so one thing I would say is there will be no press release following this particular meeting. So you won't get a lot of specifics, but Janet Yellen will be making a speech tomorrow. So perhaps during that speech we'll get some ideas from her.
Mark, hi, morning. What's the view on China? Because, clearly concerns about an economic slowdown refuse to die down. We've seen that with the recent PMI data as well.
Well, in my opinion, there's no correlation between economic growth and stock market performance. And it's not just an opinion, it's actually backed up by statistic fact. There's been lots of studies done to prove this. And what moves share prices is cash flow. And so that's why I like China, because I think the hidden beauty of China is the deceleration in GDP growth will force companies to become more efficient. And companies in China have been so silver-spooned on very high GDP growth and low interest rate loans. Basically, it's been too easy for too long. So when they become more efficient, I think they'll also become more profitable. And ironically, the slowdown will produce a bull market in equities.
Mark, if I look at India in an isolated manner, Indian markets are at a record high. But the minute I compare India with other emerging markets, if I look at the relative chart, the relative outperformance, the outperformance is not all that stark. So do you think the current price action in India has got nothing to do with elections or Indian economy? This is global liquidity which is simply moving from developed markets into emerging markets, and India is a big beneficiary.
No, I think it has 80% of it, if not more, is election related, because if you look at Russia or you look at Brazil, the other big BRIC components, and of course China as well, they have not been nearly as good. So it is the election, and in many countries, including India, I think politics are very deeply impactful. And so, the idea, which I fully concur with, that Mr. Modi will be able to translate some of his success in Gujarat nationwide by reducing state involvement and bureaucracy and improving infrastructure. Those have been huge headwinds to the Indian economy, and so that's why it's going up.
So at the current juncture, do you think Indian markets are already pricing in a stable government? Are they already pricing in some degree of economic uptick, or a stable government will still be a positive event for Indian markets? And if we get a stable government, Indian markets could rally further?
I think that they can go up further. I think they can and will. And I'll just repeat myself, but I think that there's so much bureaucracy in India. I've never lived there myself, but friends of mine who live there tell me these stories about everything from getting a passport to trying to set up a company to, trying to get a loan from a bank. I mean, it just sounds like an absolute nightmare. And if they can cut down on some of that red tape, the impact on the economy would be extremely beneficial. And I'm an optimist by nature, so I think it's going to happen.
So sectorially then, what would be your stance right now, Mark? Because we're seeing this interesting play between cyclicals versus defensives, and time and again there is this stance shift amongst market men.
I'm afraid that I lack the time to spend, and I should be spending a lot more time on the individual counters there. So I really can't provide you much granularity. I'm sorry about that, but I would just say broadly, things relating to domestic consumption and infrastructure should benefit from the new government.
Mark, a very basic question is that how come no one is taking notice of the Fed tapering program? When we started the year, the key assumption was that liquidity will only get tighter and tighter because US Fed will continue to taper. Well, the US Fed has decided to taper more, and they will taper more going forward. But if I look at the global liquidity picture, the global liquidity picture is not scary at all.
Well, I think because we already had the big sell-off, which started in, I guess it was March last year, when former Fed Chairperson Bernanke first said that he could taper. And so the sell-off happened in the summer before the tapering even started. And actually, it's not true to say that tapering's having no impact now. I think it fully explains the reason why the U.S. markets are flat year to date, which they are. It's because there's less liquidity going into U.S. stocks. But emerging market stocks were so beaten up last year, including India, that they offered value. And so, you know, it's not always a case where emerging markets have to go down just because there's less liquidity in the world. The other important part is that that big correction in emerging markets was a catalyst for policy U-turn on the part of a lot of governments and central banks in emerging markets. They raised rates, they removed subsidies, various other things. And now we've got elections coming up in several important emerging markets, including India, which looked very unclear a few months ago. Wasn't sure, in the case of India, for example, back in the fourth quarter, if BJP would win, and now it's looking much clearer.
What's your view then on the political tensions between Ukraine and Russia, and does it seem like this could get ugly anytime soon and thereby have repercussions on global equities?
Well, I speak with Russians about this, and they themselves say it's very difficult to forecast, but it certainly could get a lot worse. And then, you know, what the impact is on the world markets, I tend to give it a pretty low grade on a score of 1 to 10. I'd give it about a 3. And I don't mean to be dismissive of wars because, of course, they're the most tragic thing that can happen in the world. But if you think back to Bosnia, for example, in the 90s, did that really stop the big bull market in global equities? No, it didn't. Now, you could argue Bosnia is a little different from Ukraine because of the gas, but I really don't think that it will be a big issue for global markets. And in fact, ironically, I think there's opportunity to buy some things in that part of the world because they've fallen so much.
Mark, sell in May and go away. That clearly has worked in the last 3 years. For 2011, the May sell-off was led by PIGS crisis. It was the fear of a breakdown in European Union in 2012, and Fed problem kick-started a big sell-off in the month of May 2013. Do you think sell in May and go away will work this year as well?
I think so, but I don't necessarily believe the market's going to crash because it hasn't really done much so far this year. If you look back at the past charts, it went up until May, and then it corrected, and then it finally regained where it was at the end of April, 6 months later. But since we've just gone sideways so far this year, I just think we keep going sideways in the U.S. or maybe down a little bit, but not a major correction.